So US inflation is now running at 4.2% on an annual basis, according to the CPI for April. Producer prices have been rising the world over as the input costs for production creep up. But we're told by central banks that all of this is just temporary. Inflation may kick above the level that they're happy with, the level at which they would normally, when inflation gets too high, start pushing up their interest rates, because almost every central bank is saying that inflation that we're seeing at the moment is only transitory. So does that mean companies who are pushing up their prices now will pull them back down again later? When does that ever happen? So is it transitory? And if it is, what follows? Less inflation or perhaps deflation, which is something that analysts were talking about before the pandemic hit? We'll look at all of that today on the Debunking Economics podcast with Professor Steve Keen. I'm Phil Dobbie. Welcome along. So it's interesting, isn't it, how the US, Steve, is seeing inflation creeping up, even though they've got 8 million people who were in work before the pandemic who are not working now. So, I mean, you can, and obviously the circumstances are extenuating this time, aren't they? Because it is, this inflation is largely driven because of supply chain difficulties. But it shows you can have creeping inflation without reaching anywhere near full employment. You can have quite a high level of unemployment, but still see inflation kicking in.
Yeah, I mean, this is a very unusual experience. Yeah. So let's frame it properly. This is the first time we've actually had a recession that was caused by a shock to the economy, which is almost a reason for the neoclassicals to break out the champagne, because that's what they think everything is caused by, shocks to the economy. Well, here's a shock, but what comes out of that is a large amount of supply chain disruption, which is something we haven't ever had as a major issue in any previous outbreak of inflation, like, for example, the 1980s. When you go back to the 1970s to the early 1980s, that was before America began to en masse ship its production facilities offshore to the third world to take advantage of low wages. China didn't enter that game until 81, 82. So you didn't have the same capacity to shock the supply chain back then that you have this time around. And then when you do it, what it means is suddenly stuff just isn't available. And so the normal expectation economists have is, well, cut the supply, price will rise, intersecting supply and demand stuff. But in reality, this tends to have an aggregate demand impact as well. And if you have economy which has got very sluggish demand, and you hit it with something like that, then you have suddenly what you get coming out of it potentially is a drop in consumption, not an increase in price. So the supply side price shock can come in. For example, I believe lumber has gone up dramatically in America.
Yeah.
Okay.
So it's something like 12 or 13% increase in the cost of building a house because of the increase in the price of wood in the United States.
Yeah, which is huge. Yeah. Now, what then? The question then is, well, what's the flow-through effect of that? So if you're in a booming economy when people are borrowing hand over fist, go and build those houses so they can get them to flip that house game, then they'll go take out additional credit to finance that increase in the cost of materials, and that additional credit turns up as part of aggregate demand in the economy as well. And out of the two, you will get a flow-through of that increase in supply price. There'll be an increase in wages coming out of it as well. That will again come back and both kick up prices, but also kick up aggregate demand, and you get a aggregate demand-driven follow-through from that initial supply shortage disturbance.
So is that what's happening now? Then, do you think? Because we're coming, we are seeing demand increase because we're all coming out of out of the crisis in various parts of the world, and people are getting back to work, and they can shop where they couldn't before, and so this supply chain disruption is pushing prices up because the demand has increased.
There's a touch of that there, but the touch is going to be attenuated by the inability of anybody to turn that dipping into their pocket into dipping into the bank credit. Because again, I mean, when you again looking at the data, it hasn't been the household sector that's borrowed money during the pandemic. The level of household debt to GDP has risen, not because households have borrowed more money, but because GDP has fallen. So the denominator has fallen, the ratio rises. But corporates have. Corporates have taken on a large amount of additional debt, largely because I think they've had to do that to be able to maintain solvency and be able to meet their commitments by extending their credit lines. But they're not going to keep on doing it. So the flow through that means that an initial supply shock, which we're seeing now, and initial additional spending, because yes, people are coming out of being, having to live as hermits for the last year and a half, and the other spending to celebrate not being hermits anymore. But the sustainability of that out of cash flows is limited. If you want to keep it going, then given the level of debt people, and they've got to borrow more, and they're not going to borrow more. So I just don't think the stimulus overall is going to be there to sustain that level of price rise.
Well, they're going to have to push their prices up, aren't they? I mean, even ignoring these supply chain issues, you've got a lot of companies that have borrowed to survive, and they have to recoup that money because they can't borrow forever, and they're not going to see full demand for a while yet, I don't think. Then they're going to have to push their prices up to try and pay back some of that debt, aren't they?
Yeah, but then the question is just how effectively can they do it at the aggregate level? So, I mean, if you individual, yes, you put your prices up. What's going to be the impact of that on you? Now, if you have the booming economy we had back at the end of the 60s, which is when inflation first took off. So if you look at the data, the real takeoff to inflation between still very low in 69, I think 71, 72, 73, it began to really expand. So the 71 to 75 period is where you see the big jump in inflation initially, with at the same time an enormous credit bubble going on globally. So that's your initial boost. Now, so in that world, when you put your individual prices up because you have to, then the money is created by the new credit coming into the economy to enable that to be sustained over time. But when you have what's happening now, you're not going to have that sustained capability, and this is where thinking about it in terms of the actual cost structure of firms becomes important, because in neoclassical textbooks, the higher the supply, the higher the price of production. Their models have a rising supply curve, so you have to pay more. If you want to get more thing produced, you've got to pay a higher price for it. That's all based on the idea of what they call diminishing marginal productivity. So to produce more output, you've got to hire more workers working in the same amount of machinery. Their productivity goes down, and therefore the amount being produced goes down relatively. You get more of an increase in cost than you get an increase in output, and that puts your prices up. In the real world, firms face constantly declining marginal cost. So rather than the firm having a rising levels of marginal cost causing its prices to rise, it actually, if it can expand output, it has
as demand increases,
cost of production.
Yeah.
And in that world, your markup rises, your margin will rise without you doing anything about it, because your per unit costs are falling.
Yeah,
that's the real world.
Yeah, the real world, which everyone will understand that. Does it cost you more per unit to create 1 million of something versus creating 20 of them? Obviously, it's a lot cheaper to create 1 million, and if the demand is there, then you're going to sell that million, and you're going to be able to charge less for them. But this point about people being in debt, corporations being in debt, and wanting to pay it back, they obviously the money they've borrowed is new money from commercial banks. It's new money being created by commercial banks. So the money supply is increased. If at the same time we've got governments creating money and spending, so that's more money being increased. So the money supply, the M2, however you want to measure it, the money supply it has increased hugely through this crisis by the combination of corporate borrowing and governments. So governments are going to want to cut back on spending. Those corporations are going to want to cut back on borrowing. So the money supply, as they pay it back, is going to start shrinking, isn't it? So that you could argue, would be deflationary rather than inflationary.
That's what I think is going to happen, because if we had the conditions of the late 60s and early 70s, and you had this price shock coming through, and in a sense what we're talking about now is an extreme version of OPEC, which actually happened back in 73. So in the OPEC price rise after the Yom Kippur War, the Arab states put a blockade on sales to America, which increased the price of oil from $2.50 a barrel to $10 in 1 year. And now, in that situation, because there was already a boom going on at the same time, there was an increase in the money supply, because firms would access their lines of credit to pay that additional cost rather than paying down their own cash reserves. And workers also, because it was a booming economy, demanded wage rises to make up for the high cost of gas, and you got an inflationary surge which was sustained. But this time round, because there's just not that, you're not going to go, you want to reduce the level of debt now, you don't want to increase it. So that price rise will cause the prices to rise, margins to fall, but then there won't be a continuation of that demand. And I think we'll see it going from an initial supply-driven price rise into effectively a credit negative credit deflationary experience, and you won't get that sustained rise in prices.
Wow. So from short-term inflation that everyone is predicting to longer-term deflation that nobody's talking about. Although, interestingly, we were talking about deflation a great deal, weren't we, before the pandemic came along? Does that mean there's going to be no end to stimulus and support from central banks? We'll explore all of that in the full version of this podcast. If you want to hear that, then you need to become a supporter of Steve Keen on Patreon. Go to patreon.com/Prof Steve Keen, or become a subscriber at debunkingeconomics.com. Do either of those two things and you can listen to this and all the other 200 or so episodes of this podcast in full. And that's it for this week, though. I'm Phil Dobbie with Steve Keen. Back again next week. Thanks for listening.